All right, so a few, I guess, just the quick reminder about the uploading of the vaccination. Oops, what just happened to Blackboard? Uh-oh. Okay, well, I sent, as you know, I sent information about uploading your vaccination documents. This does not apply to our class in the sense that you don't need to have vaccination documentation to continue with online only classes. But if you have a class that on your CUNY first shows as in person or hybrid, you have to make sure that you have uploaded your vaccination documentation by today, which is September the 27th. And that is so that you would be on record as having been vaccinated and be able to attend in-person courses. Hybrid is also, considered in person in the sense that at least one day of the classes or some portion of the classes are in person, because that starts on October the 7th. So again, I sent this out last week, and I believe we spoke about it also during the class, right? We spoke at length. This is, not opening up any type of debate around vaccines, rather just to remind you that today is the last day to upload this information. If you are having trouble uploading the information, remember there's all kinds of help. There's a video, there's still synchronous remote remote support, even today, 2:15 to 3:15. And then there's this in-person support at the bursar. So maybe you are on campus for work or something, you can just make sure that your vaccination information is also uploaded properly so you can continue with your classes. All right, so we haven't been told at LaGuardia, it hasn't come from CUNY yet truly what exactly is going to happen on October the 7th if people haven't uploaded their stuff. But at this time, all CUNY, I shouldn't say we haven't been told what's going to happen. We've been told that people will be dropped from their classes, but the logistics around that has not been, discussed. So if you have a class that meets on a Thursday, October the 7th is a Thursday, that should be the first day that class is starting to meet in person. Please be sure to get your vaccination information uploaded. I had sent information also last week that I did get figure out the issue with McGraw-Hill with the registration thing. The McGraw-Hill rep had put our registration window from September the 1st to September the 20th, which was why people who were registering on the 21st and the 22nd couldn't get in. So I changed that date so that you have registration. And then someone in the class, explained, and I know a lot of people already registered, so I'm not going to spend much time on this, but just explained that the $90 access was kind of like for the semester, just I guess a reduced rate access. So I think we're also okay on the textbook questions that we had last week. Okay, so vaccination, textbook questions, and then let me see if anybody has any questions for me before I just revisit the calendar of due dates. Anybody have any quick questions about anything? All right. So just to remind you, we are on the 27th. Today is the last day. We should be able to finish chapter 8. We finished on periodic LIFO FIFO average cost. We're going into perpetual LIFO FIFO average cost. And then the last thing in this chapter that we need to do is dollar value LIFO. So we'll spend a little bit more time on the LIFO question, specifically dollar value LIFO. And then Reminder that the first homework, chapter 8 homework, is due on October the 4th. Again, might seem like it's, far away, but it's not actually that far away. In fact, it's next Monday. So if you are, thinking about when you're going to get this done, please think about how your week is going to go, because the homeworks, right? Remember, the homework has a pretty high total weighting in the course. It's 3% per homework per chapter. So make sure that you are planning on how you're going to get that homework done. And again, the homework is this chapter 8 homework in Connect. So again, if you have questions, ask me. Then by now, I think I've got from most of you, if not all of you. I just have to do a final count, but most people have sent me their choice of company for the term paper. If for some reason you haven't sent it yet, which I'm not sure that there's anybody that hasn't, but just in case, please send it so that you have made a choice, because it's, there are companies that are already full, like Netflix, Apple, and I think Nike is also full. I can double check, but I think Nike is full already. So you're left with only a few other choices. For those who want to get a head start on the work, remember you have an option. It's not required, but you have an option to submit a draft of the A part of the term paper by October the 10th if you want me to read it for you, so that you can see which changes you need to make, if any. So if you give it to me by October the 10th, my hope is that since we don't have classes on the 11th, that I'll just be able to read it on the 11th and return it back to you so that you can continue with your work. All right. So again, if you want me to read your paper, please start looking at the term paper. If you can't remember where to find the content of the term paper, remember I explained everything on the first day, so it was a lot of information. It's under assignments. The term paper counts 15% of your grade. It's 4 to 6 pages, which is not a lot of writing. It's double spaced pages, so you don't have to write, an insane amount of stuff. The sooner you start, the better. If you submit by November the 17th, I'll add 5 points to your grade, regardless of, even if your grade is, I don't think anyone's necessarily going to get 100%, but even if your grade is close to 100 and the 5 points pushes you over 100, I'll still add them. And then the final submission date is just before Thanksgiving, November the 24th. All right. So again, if you want to, you can send me an optional draft. These things are happening next week. The first homework is due next week. The draft of the paper, if you want to do it, is next week Sunday. All right. Next week Monday is the homework. Next week Sunday is the term paper draft. Any other questions here, folks? I'm kind of just, I generally just try to run through the schedule as much as possible so that people don't end up saying they didn't know, that something was due. You should be marking your calendars anyway, but, I don't want any surprises. I know someone was remarking on, the first test only starts on October the 19th. But again, by next week, we're in October, all right? By the time we finish with chapter 9, the first test, which is on chapters 8 and 9, is basically right there. So, these dates sound far away. It's like, oh, it's a month away. But with all your other classes and everything else that you have to do, there's a lot of work for you. So please plan accordingly. All right. So if there aren't any questions, let me go back into where we finished last time. I'm not going to rehash all the work. That would be, time that we don't have. But remember, we were looking at an example 3 in the class examples, FIFO, LIFO, average cost, and And, sorry, just one more thing. If you're looking for where the stuff is, remember everything that you need for the lecture is under Zoom notes and examples. So I'm just working off this example number 3. And we had said this company had a total of 11,000 units, a total of $71,500 was what was available to be sold. 6,500 units had been sold. You guys told me 4,500 units were left behind in ending inventory. And last time we did the periodic method and we did FIFO, LIFO average cost. We said again that with FIFO, we're going to use cost of goods sold, right? As like starting with cost of goods sold, you can also do ending inventory as your starting point. But I just said we were doing cost of goods sold because it's a little bit easier to think of. The first thing in is the first thing out. So the first thing that we bought is also the first to be sold. So we said that when you look at FIFO, your cost of goods sold is always the earliest units with the lowest prices. Okay, the earliest units with the lowest prices. Your ending inventory is always the latest units with the higher prices, assuming that prices are increasing. And that sometimes you may find that there's a batch of purchases that have to be split between cost of goods sold and ending inventory. So in the end, we had 38,500 as our cost of goods sold. It goes to the income statement, and 33,000 as the ending inventory to the balance sheet. And also showed you that there are shortcuts. That if you know that the total cost of goods available for sale is 71,500, if you either calculate cost of goods sold or ending inventory, you can deduct that from the total cost of goods available for sale to get to the other amount, right? If you just want to do a quick calculation as opposed to pricing everything out. Then we did LIFO, and we saw the difference here that with LIFO cost of goods sold, it's the latest units with the highest prices that end up making up cost of goods sold. So you find that cost of goods sold under LIFO, right, is higher than under FIFO, which means that you end up having a lower net income under LIFO, which gives you lower taxes. So we're saying LIFO, right? LIFO has a higher COGS, which leads to lower net income, which leads to lower tax. And that's why over the years, a lot of US firms, well, I mean, a lot is probably stronger, but they are a significant number of US firms that have chosen to use LIFO because they can save on taxes. They also use the LIFO method for their tax reporting, and eventually, well, some companies were using LIFO for tax, but not for accounting. So eventually the IRS said, look, if you're using LIFO for taxes, then you should be using the same thing for your accounting. Otherwise, it's just kind of like, I mean, I don't want to say a scam, but it's not great that you're simply using this method just to avoid taxes. And we saw that, it's billions of dollars of taxes that have not been paid because of LIFO. And I also mentioned to you that international accounting standards don't allow LIFO. And under LIFO, ending inventory is the earliest units with the lowest prices. So it's kind of like the quote unquote old units that were there from long ago that are priced as ending inventory. So the ending inventory is lower than under FIFO. And I had mentioned to you that the cost flow assumption is not necessarily the same as the actual physical flow of the inventory, because when you're looking at a store, like even let's say a clothing store, right? People, because of fashion trends and things, people are often looking for the latest things that just came in, the season change. They want, the most up-to-date clothing. So, no one's going to come to them and say, well, we don't want you to buy this, we want you to buy that, because we have to assume that the inventory is moving in a certain way. The inventory just gets sold however it gets sold. This is on the books, okay? This is all on the books that we make these assumptions, whether they actually match with what was happening in the store doesn't matter. Okay, we're not trying to say that the cost flow assumption is the same as the physical flow of goods. This is just what the generally accepted accounting principles allows us to assume about the flow of goods to make it a little bit easier for us to cost these things out. And then the third method we said was average cost. And we also said that average cost is easier to calculate than the other two. Average cost is not dependent on LIFO or FIFO. It's its own separate thing. It uses a formula to come up with the weighted average cost per unit. So it's the total cost of goods available for sale divided by the number of units available for sale, gives us a cost per unit. And that cost per unit is then applied to the units that were sold and the units that remained. And we saw last time that the average cost numbers for cost of goods sold and ending inventory generally end up in the middle between FIFO and LIFO, right? So it's pretty true to its name that it's the average cost of the inventory. So average cost is easy, it's simple, but the drawback there is that it's not as accurate in terms of really keeping track of the changes in the price of goods. I mean, if you look at this, right, it's saying that the goods cost $6.50 per unit, which is true. But if you look at how the inventory changed, the price of inventory by the last purchase that happened in October, the price of inventory was already $7.50, right, per unit. So if you were just using average cost, you may not have as much of an up-to-date knowledge of what the price of the inventory is now, and that, isn't so helpful if you're trying to make decisions about what your budget should be or how much inventory you should buy, and so on. So again, average cost is easy, but it's maybe not as accurate and maybe not as useful for decision making. So that was the periodic system. Now we're going to go into the perpetual system. And remember, last time I showed you that this example is basically, the same as what's in the textbook. So I'm working it through with you because I find it not as useful for me to just open the textbook and point at things and you kind of have to assume that how they're being done. I'm trying to work it through with you, but if you want to refer to the example, if you have the textbook open, you can also just look in there, or after this, if you want to see, more information about this, it's basically the same example as a textbook. So now we're going to come to the B part here again, which is the perpetual method, right? And we said that perpetual means that we are constantly updating our records, which means that as things are being bought and sold, the balances in inventory, are changing, and we have to take that into account. Now, the first thing I'll say about under the perpetual method, is that FIFO is actually going to result in the same dollar amounts for cost of goods sold and ending inventory under the perpetual method as the periodic method. And the reason for that is that we're assuming that the first thing in is the first thing out. So we are always looking, when we're looking at cost of goods sold, we're always looking at the oldest items, even under the perpetual method. So it's basically going to end up being the same items that we were using under the periodic method. So I'm going to just start us off here with kind of setting up the situation. So this is going to be perpetual FIFO, and even though it ends up being the same, dollar amounts, I'm still going to show you how it's done, because, not only for this class, but even when you go to your 4-year schools, you guys will run into this information or into these questions again. Okay, so this is how we're going to set up the table. There's going to be, what date are we dealing with? Was something purchased? So was it bought or was it sold? And what is left in ending inventory? And so in the end, the sold cost of goods sold, the sold column is going to give us the cost of goods sold number, and the balance column will give us the ending inventory number. Remember, that's the purpose of our calculation. So we start with beginning inventory, and this is on January 1. And this inventory is not purchased on that day, but it's just easier to put the inventory under purchase, right? So if we go back up here and, just to remind you, on January the 1st, it's 4,000 units at $5.50. I can hide. Let me see quickly. It makes sense to hide, and then later on, I just have to remember to unhide the stuff because. All right. So just so I don't have to scroll so far. So on January the 1st, we have 4,000 units at 550. So that's what I'm going to punch in here. So 4,000 times $5.50 equals $22,000. So same thing, right? Over here, I probably don't even need to do this. I can just do that. So we know that it's just the balance. Okay. And then we have to watch the dates carefully because now we're going to mix, let's call it mixing together the purchases and the sales under perpetual, because under periodic you wait till the end, everything that happened, so you can do the sales and the ending inventory separately. With perpetual, you're updating the records as things happen. So you start with January the 1st, but then the next date is January the 10th. So that's what you have to take now. You can't, ignore the fact that there was a sale. So January the 10th, there's a sale, and it's for 2,000 units. And now the question is which units. We obviously know that it has to be coming out of this balance over here. So it's 2,000 units at 550. We don't care about the sales price. We're not trying to price out revenue. We're trying to price out cost. Okay, that's why we don't worry about what was the selling price of the stuff. We're concerned with what was the cost. So we sold 2,000 units. We know that they have to be at this price because the first thing in is the first thing out, right? So that must mean then that if 4,000 were here and 2,000 were sold, then what is left is still 2,000, right, at 550, and that equals 11,000. A little bit confusing maybe because it's the same thing twice, but we're just saying that we sold half of what was available to us. So that's, stop me if this is not making sense. You guys are very quiet today, so I'm assuming it's because it's Monday. But if it's because you don't know what's going on, just stop me, because I kind of feel like I'm, going a little bit fast, but no one's slowing me down. So so speak to me if you have questions. So then the next dates, remember it's perpetual, we got to go by dates, not just wait till the end. So the next date is the 17th of January, and this is a purchase. So we purchased the 1,000 units at $6 each. So what we do with this table here is we put the date, and then we say 1,000 times 6, equals 6,000. So the 6,000 units, and actually this is easier seen if I skip one line. Okay, so the 6,000 units are obviously not sold. So now we calculate what's left over. Well, we know that this was left over from before. So on the 17th of January, this layer of inventory is still there. And then on top of that layer, we also still have this. So in inventory at this point, we have $17,000, right, of inventory. We're keeping track of this because at the end, it will tell us how much is in ending inventory. So I repeat, right, we started with 4,000 units. We sold 2,000 of those units, which leaves us with 2,000. This is all at 550. Then we bought another 1,000 at 6. So in our ending inventory, we still have 2,000 at 550, and we have 1,000 at 6, giving us a total ending inventory on that date, 17th of January, of $17,000. Then we go back up and we see, okay, the next date is the 22nd of March. We bought 3,000 units at $7. So we're going to go to March the 22nd. Purchased 3,000 units at $7, which is obviously $21,000. So we still haven't sold anything. So at this point, and notice how I'm keeping the inventory in the order of what was purchased first, right? At this point, it's the 2,000 at 550 that's still there. There's 1,000 at 6. And then there's now this 3,000 units at 7. It's important to keep this in the correct order of the earliest, to the latest, because if we sell something, we have to know which layer of inventory that sale is coming out of. Okay, so I'm being very particular about keeping these in the order that they came in. So then we go look again to see what happened next. Okay, so the next thing is a sale on the 15th of April of 1,500 units. So we're going to say April the 15th. It's, sorry, not purchase, it's a sale. It's 1,500 units. Now the question is, what was the cost of those units? Since we're doing FIFO, the first thing in is the first thing out, and we know that we still have 2,000 units at 550, right, left over. The 1,500 units must be coming out of this batch, right, because we're always selling the earliest units under FIFO. So then that is 8,250. So now the question becomes, what's left over? Well, we used to have 2,000 units, but we sold 1,500. So it must mean that only 500 units are left at 550, which is going to be 2,750. So that's still in ending inventory, right? And then, of course, we still have the 1,000 units at 6, and we still have the 3,000 units at 7. So on April the 15th, this number over here, what is this, 28,750, that's how much you have remaining in your inventory. Still no questions, okay. So now we say, okay, what's next? Going up, right? So you've still got 2 dates left over. You've got October the 15th and November the 20th. So obviously October the 15th is earlier. So we're going to do that. That's a purchase, right? So on October the 15th, we have a purchase of 3,000 units at $7.50. Is going to be 22,500. That's the purchase. And so at that point, nothing was sold. So again, we have to keep track of everything that's available to be sold. We go from the earliest date, it's 500 at 550, 1,000 at 6, 3,000 at 7, and now this 3,000 at 750. So all these things are still in your inventory at that date. And then the last date is November the 20th, when we're actually now selling, and let's go see how many we sold. 3,000 units of inventory, right? Remember, the first thing in is the first thing out. So we have to start with the earliest units. There's only 500, but we have to take those. So 500 at 550, sorry, is 2,750. That's not enough because we sold 3,000 units. So we still need 2,500 units. The next batch is 1,000 units. So we'll take that. So that's 1,500 units, right? So we still need another 1,500 units. And that 1,500 is going to come from this batch over here. So we're going to say 1,500 times 7 is 10,500. Okay. So this last sale of 3,000 units kind of becomes the most, I guess, complicated one, because it's taking inventory from 3 different batches to make up the 3,000. So our first layer of inventory is gone. So there's nothing left over. We sold all of that. We also sold all of our second layer. So that's gone. The third layer, this one, we took half of it, right? So the other half is left over. And the last layer of 3,000 at 750 wasn't touched at all. So that stays in ending inventory. So if you wanted to calculate what your ending inventory number is, you say it's 10,500 plus 22,500, right? And if you add that up, you're going to get to the same ending inventory that we had under, sorry, I don't know what I just did. Oh, I put print by accident, sorry. we're going to end up in the same ending inventory number that we had under periodic. If you go and look at your calculations, it's the same. And it has to be the same because with FIFO, because the first thing in is the first thing out, we're always selling the earliest units and leaving the latest units behind. We'll see that LIFO is going to be different from that. And then for cost of goods sold, right, you're going to scroll up here and you say, okay, it's 11,082.50, right? These are all the numbers. And then all these other, this combination of numbers here. This combination of numbers, let's just say the total of the year is 19,250. So our cost of goods sold in the end is 8,250, which is from the second sale, and then 19,250, which is from the third sale. So if we add these up together, they come up to 38,500. And 38,500 again, if I ungroup this quickly, just ungroup this. Yeah, 38,500 was what we had under periodic, and 33,000 for ending inventory was what we had under periodic, because it's the same units that we're pricing out when it's perpetual or periodic. That's just how FIFO works, because the first thing in is the first thing out. LIFO is not going to be the same. Otherwise, it'd be just doing long-winded calculations to get to the same answer all the time. Questions, guys, or anything that I can repeat before I move on to perpetual LIFO?
I'm good.
You guys are okay? All right. All right. This is good news. If anybody is not good, you can wait till the break to ask, or you can ask in the chat. All right. So we go. Sorry. Oh, okay. We'll go to perpetual LIFO. This is where things get a little bit, I guess, more interesting, for lack of better phrasing. Because with LIFO, the last thing in is the first thing out. So when we end up selling stuff, we are looking at the most recent layer of inventory to use as the cost of goods sold. And so, you really have to keep track of your inventory layers to make sure that you are doing cost of goods sold out of the correct inventory layer. So we start obviously with the beginning inventory again, right? It's from January the 1st. So I'll just put it as a balance. So it's 4,000, right? At 550 old news, we know it was 22,000. Then because you update every time something happens, on January the 10th, there's that sale. It's the 2,000 units. It's going to be at 550 because there's nothing else, right? So it has to be at 550. You're selling 2,000 units. You're selling half of your inventory, which means that ending inventory is the other half, right? To make up the 4,000. So up to now, it almost looks like FIFO and LIFO perpetual are the same, but that's just because you only have this one layer of inventory at this time. But as we buy more inventory and then do our sales, we will begin to see that things will change between FIFO and LIFO perpetual. Now we come to January the 17th, and we know that there is, I'm working from remembering this, but just to remind you, 1,000 units were purchased at $6. So it's 1,000 at 6, which is obviously 6,000. There's no sale. So we will now just say what's left in ending inventory. Remember to be very precise about keeping your layers in the correct order of dates. So you first pull down your 2,000 units from January the 10th, and then you add your January the 17th 1,000 units. And now we go and look to see what happened next. Well, it looks like on the 22nd of March, we had another purchase of 3,000 units. So we'll do that now, right? So it's 3,000 units, excuse me, at 7. So that's 21,000. And so again, just pull everything down. This is the earliest layer. This is the next one. And this is the last one. Notice how the prices increased, right? Over time, the price increased. So now on April the 15th is when we have a sale again. And that sale, if I go back up to remind myself, that sale is of 1,500 units. Okay, so 1,500 units. Now the question is, which 1,500 units? In other words, what dollar amount? Am I using the earliest ones, the middle ones, or the latest ones? Then I have to say, well, the last thing in is the first thing out, right? For LIFO cost of goods sold. So that must mean that I assume that the latest units are sold first. So the 1,500 units that I'm selling, I assume that they had a cost of $7. Okay, this is the crux now of where the split happens between LIFO and FIFO. Because if we were doing FIFO, we just assume that it was the earliest units that were sold, because the first thing in is the first thing out. LIFO starts at the bottom. All right, so 1,500 times 7. So yeah, the cost of goods sold is 10,500. So immediately your cost of goods sold number under LIFO, even perpetual LIFO, is going to be higher, right, than FIFO, because LIFO is assuming that the latest units with the higher prices are being sold first. So now the question becomes, what's left in ending inventory? Keep your layers, accurate. You start with the oldest ones that are still there. And then this most recent layer has to be split in two, because you assume that half of it was sold, and now the other half, the other 1,500, is left over. So that's what things look like after the April 15th sale. And now if you go back to the question, you start seeing that the next thing that happens is on October the 15th, and that's just a purchase. Sorry, that's just a purchase. The purchase over there, 3,000 at 750. So we're going to record that 3,000 at 750. It's 22,500. And then again, we've got to be disciplined about pulling our LIFO layers down accurately. And then the latest one is the 3,000 at 750. So now we know how the layers look, and we know that if we have a sale now, which we will on November the 20th, that anything that is sold is going to be assumed to come out of the latest purchases, right? The last thing in is the first thing out. So now we have November the 20th. It was 3,000 units, okay, that were sold. I'm taking it straight off the question. There's the 3,000 units that were sold. Notice how with all these methods, right, the number of units sold, the number of units left, all those things, the unit amounts are exactly the same. It's just the dollar amount that you apply to that unit that will change depending on which method you're using. So we know that we sold 3,000 units. Now the question is, which 3,000 units will be assumed to be sold? So we know last in is the first out. It has to be the 750. Okay, so we assume that it's the 3,000 units at 750 that were sold, which is 22,500, which then means that these units are still there, the 2,000 units, the 1,000 at 6 is still there, and the 1,500 at 7 is still in ending inventory. And so if you want to calculate how much is your ending inventory, which is the point of this exercise, right? Calculating ending inventory and cost of goods sold, you add these things together. 11,000 plus 6,000 plus 10,500 is going to give you 27,500. right? It's the 11,000 plus, sorry, having that thing this way, 11,000 plus 6,000 plus 10,500. Okay, and then how about cost of goods sold? Well, you're just gonna go up and add everything that's in this column. So it's 11,000, 10,500, and 22,500. So it's 44,000. Another way of doing it would be to say I started with 71,500 total cost of goods available for sale. I know that ending inventory is 27,500. So it must then mean that cost of goods sold is 44,000. Okay, it's kind of the same thing, it's just using those shortcut methods that I was talking about last week to come up to the same solution. Notice that under perpetual, LIFO LIFO perpetual method is resulting in different ending inventory and cost of goods sold numbers than LIFO periodic. Okay, because with periodic, you wait till the end and you list all the stuff out and you just do the calculations based on purchases and sales that already happened during the year. With LIFO perpetual, the assumption is that you are doing these calculations as you go along. All right, so it's going to result in a different number. Any questions on perpetual LIFO?
I'll do Professor.
Okay. All right. Well, anybody has a question, raise your hand. I'll keep moving on. Things may strike you. I'll do average cost. Questions may strike you at the end when we kind of summarize this or during the break. But let me then move on to, perpetual average cost. And so under perpetual average cost, you're calculating what we call a moving average, because every time something gets added or sold, you have to calculate what the average cost of these units is. So let me pull down these headings. The headings are all the same. Again, this is all out of the textbook. I'm just working it for you so you can see. In the textbook, it's presented as a completed table. It's all done. But here we can see how it's being built up from scratch. So same story. You start with beginning inventory, right? 4,000 units. We know already, we can recite it from memory. 4,000 units at 550 gives you 22,000. There's no average to calculate there because it's only one batch with that price. That is the average cost, right? There's nothing to do. And so again, we move on to the next date because this is perpetual. We go by dates and assume that this work is actually being done on January the 10th. With periodic, your work is being done at the end of the year or the end of the quarter. Perpetual is being done on the date that you're writing here. So on the date, January the 10th, we sold 2,000 units. So it's 2,000 units. The average cost has to be 550. There's nothing else besides that. So with all three methods, you see that first sale over here, because we have the beginning inventory and then we immediately have a sale, we don't have a purchase, to throw things off for LIFO and average cost. Because we have an immediate sale, each one of these methods, the first two entries are the same, right? Now we come to January the 17th, which was a purchase, right, of 1,000 units at $6 per unit. So obviously 6,000. And so what do you have in your ending inventory right now? The 2,000 at 550, the 1,000 at 6, which gives you a total of 17,000. We discussed that total before, but now we actually have to use that total to say what's the new average cost per unit. And why are we calculating this now? Because we started to add more inventory into the mix. So we can't assume that 550 is the average cost anymore, right? We just bought something that was at a different price. So the average cost is no longer 550. So what we'll do here is we'll take the total cost of the inventory, 17,000, and we'll divide that by the total number of units in the inventory, which is 3,000, right? So let me write units so it's obvious. So it's 3,000 units, $17,000 and 3,000 units. So this calculation is kind of happening, you know, in the moment. And that's going to give me 5.67, right, per unit. $5.67 per unit is the new average cost. And again, if you want to know when you should calculate a new average cost, every time you add to the inventory, you're going to have to calculate a new average cost, because if you do a sale at that point, you will have to cost it out at the average cost, and you may not know what that is if you're buying more stuff all the time, right? So that was January the 17th. We go back up, we know the next date is March the 22nd. There's 3,000 units purchased at $7 per unit. So I'm going to do March the 22nd. 3,000 units at $7 per unit is 21,000. So again, things are going to change now. Even though you just calculated the average cost per unit, you're going to have to calculate it again because you just added onto your inventory number. So you pull down your original 2,000 that's still left, the 1,000 at 6, and then you also now add to that the 3,000 at 7. And you can say, well, isn't there a way to just use this number somehow and, you know, add somehow, you know, what do you call it, average 567 and the $7? No, because do you notice how the unit amounts are different, right? And this is a weighted average. Weighted meaning that the more units at a particular price, the more that price is going to weight into, it's going to have a heavier inclusion in the total price of everything. So I can't just assume that I can add the 567 that was the previous average to the $7 that's being added in and average those two things out. I can't do that because I have to consider how many units are being purchased at that price. So it literally means that every time you have a purchase, you have to show everything that, you know, was purchased up to that point, the number of units, the unit price, add them together and divide by the units, the total units. So all of these things added together are going to come up to 38,000. Okay. So if we do the average cost per unit again, we're going to have 38,000 as our numerator. That's the dollar amount of all the units. And then how many units total? It's 6,000 units, right? Because it's 2 plus 1 plus 3. So it's 6,000 units. And so we'll kind of just make this look a little bit nicer, like an actual calculation. So what's 38,000 divided by 6? At $6.33 per unit. Oops, what did I do wrong here? Oh, I see. $6.33 per unit. So the unit price went up, which makes sense because look at the price of the most recent units that were added. They're higher, right, than the $6 that we purchased at before. So now we know that any item that is sold next, we know that there's going to be a sale next on April the 15th. The cost that we will use for that cost of goods sold for the sale is going to be $6.33. So here goes April the 15th, which is the sale, right? And we know from previous experience, I don't have to repeat this to you, it's 1,500 units that were sold. And now you use your $6.33 as your average cost of the goods sold. And so that comes out to around about, right? I'm rounding $9,500 for cost of goods sold for that batch that was sold. And so now, unlike before when we were doing purchases and we were kind of dragging things down here one by one, what we will do now is, because we have all of these items already calculated out, we can say, okay, so there were 6,000 units at $6.33 per unit. We just sold 1,500 of those units, so we are left with 4,500 at $6.33 per unit. And now you might say, but don't we have to say which 4,500 units? It doesn't really matter, because remember, we averaged out the cost of all of this stuff. So it's not going to be, you won't be able to say, oh, it's these units make up the 4,500, because everything has been costed out at $6.33 to give you a 28,500 remaining inventory at that date. So what now, right? Well, it was October the 15th. April the 15th, I'm jumping ahead in my mind. April the 15th, where we had a sale. Now comes October the 15th, where we have another purchase. And if we go up to the screen, it's 3,000 units at $7.50 per unit. Okay, so here we go, 3,000 at $7.50 per unit is 22,500. So this is what happens. Remember, I was saying that you're not just going to now say, oh, well, what's 633 plus 750 divided by 2? You can't really do that. You have to honor the fact that there's already ending inventory in existence over here. So you're going to bring down the 4,500 at $6.33 that's already there. And then you're going to say, and now we have another batch, 3,000 at $7.50. Okay. And so we add these two amounts together and then calculate a new average cost per unit. All right. So average cost per unit there, these two amounts together are 51,000. All right. And the number of units together is 7,500. So I'll just fix this again. And so we end up with a new price per unit of $6.80. So let's think carefully about this, right? You should be asking questions like, well, if over here you're just using the average cost to do this new calculation, how come you did that? But then over here you didn't use the average cost, you kind of, priced everything out again. Remember, because we had that sale, we actually applied the $6.33 average cost to our units that were sold. So what was left is at that price. Okay, we can't revert back to the $5.50 and the $6 and whatever. You can't pull it out You can't pull it back out. For as long as the inventory is unsold, you can always use the different unsold, like there's no sale at an average cost. That's what I should say. For as long as there's no sale of inventory at an average cost, that an average that came from a combination of layers of inventory, you can just keep using separate layers to calculate an average. But as soon as you had a sale of inventory that used some of these units up and put them at the average cost, the remaining units have to be at the average cost, okay? They can't suddenly be priced either at 550, at 6 or 7, because we can't discern which units these are anymore, okay? Because there's no FIFO, LIFO here. This is just a bunch of units that are left over. So the only answer is to put them at the average cost. You can't go back and separate them out and say, oh, it must have been these units that were 550 or those units were 7. So that's why this layer over here doesn't refer back to the old prices. It has to refer to the average cost because we've already sold some of it. So we won't be able to use those separate layers anymore. Whereas this one was just purchased. So we know that all these units are at 750. So we put it in at that price, and then we take these two amounts together. They become the numerator. We divide by the total number of units to give us $6.80 per unit. All right. And then on that's a little bit of a, I mean, maybe it's everyone seems fine today. I don't know, it's like the best Monday ever, but a little bit of a tricky concept, right? As to why suddenly we're using the average here, but all along we were using individual prices of purchases. It's just because you've now gone in and sold some of the stuff, so you just won't know what relates to what price. You have to keep it at the average. And then the final sale, right, is November the 20th. You sell 3,000 units. So you already know that those 3,000 units are going to be at $6.80 per unit. So November the 20th, right, 3,000 units at $6.80, sorry, 80 cents per unit is 20,400. Okay. And so now, because we already used, again, we used these two layers to calculate an average. We've now sold some of that inventory at the average cost. Our remaining inventory of 4,500 units, remember the number of units in remaining inventory is the same for all of the methods, 4,500 units. It's just the dollar amount that's applied to those units that differs. Yeah, it's easy because you know the last average cost per unit that you calculated was $6.80. So that must be the price that you are going to apply to your ending inventory. That's going to give you ending inventory under the average cost method of 30,600. So that's your ending inventory. And then for cost of goods sold, you're just going to add up wherever there was cost of goods sold. So there's 11,000, 9,500, and 20,400. So let's just do that. So cost of goods sold was 11,000, 9,500, and 20,400. So those three together is 40,900. That's your cost of goods sold, and it still adds up to 71,500. Is my math right there? Why does that math feel wrong? Sorry, 1 second. Yeah, no, that's fine. Sorry, I got sidetracked, and the math is fine. Okay. So questions, anybody? Something to be repeated, something that's unclear?
I'm clear.
Okay. Thank you, Marina. Okay, so let's do this. We're gonna let it simmer for 10 minutes. I'm gonna just stop the share and make sure I've got everybody's attendance, and then we'll take a 10-minute break. If people have something they want to ask during the break, you can ask it. And then after when we come back from the break, we'll do dollar value LIFO. Okay, so let me also just pause the record. Okay, so just a quick thing here. This is the Form 10K, which is the financial statement, annual financial statement of Amazon. I just pulled it up really quickly just to show you that these companies have to discuss what they're doing with their inventory, what cost flow assumption they're using. And they say, right, that they're using FIFO. They're primarily accounting in first out method, and that inventory is valued at the lower of cost and net realizable value. So the FIFO method is our Chapter 8 work. The lower of cost and net realizable value information is our Chapter 9 work, because there we talk about subsequent measurement of inventory, which is basically a type of evaluation of inventory. There's more stuff that they, talking about, arrangements with vendors and things that we don't have to go into. It's basically about inventory ownership. Like if someone's selling on Amazon, they're just trying to say, almost like what we were speaking about with this notion of consignment goods. It isn't actually consignment, but they're just saying that third-party sellers obviously maintain ownership of their inventory. That Amazon is not, like if I'm trying to sell something on Amazon, Amazon is not going to include the item that I'm trying to sell in their inventory. They're only going to include the inventory that's actually, their asset, a resource that they own or control. So why do we care about these things? Because you can see, let me hide this thing for a second. Yeah, I know this is from 2019, so obviously we could get something more up to date, but I just pulled something so I could show you. But even then, and it's probably more now, remember these numbers are in millions, okay, except for the per share stuff. So the numbers are in millions. So even in 2019, pre-pandemic, and remember Amazon's business went crazy during the pandemic because everybody was buying online. They already had an inventory balance of 20.5 billion with a B, right? So, when we were talking about inventory, I was saying that it's a pretty big balance for a lot of companies, and it is. It's a big balance, and it's subject to error, unfortunately, for a variety of reasons, and also sometimes subject to fraud. So the number that's sitting over here would have been determined via FIFO, right? First in, first out. That's what they're trying to say. So again, just an example of how these things play out in real life. If I had to pull the more up-to-date Amazon financials, the number will be there as well. And it would probably be relatively huge too. Okay. So, in the end, I'm back on the notes. And remember, you can find the notes under Zoom notes and materials. When we compare these cost flow assumptions, these methods, average cost, LIFO, FIFO, you see all kinds of things that are happening when prices are increasing. Average cost is just producing kind of like this middle number between LIFO and FIFO. It's not as precise, is probably the best way to say it, but it's easy to do. When prices are increasing, FIFO has a lower cost of goods sold and a higher ending inventory. LIFO has a lower ending inventory, but it has this higher cost of goods sold that leads to this lower income, which leads to lower taxes. And obviously, if prices are falling, everything goes in the opposite direction. Remember, again, this is an assumption that if prices are rising, these things are happening. Again, we said this, all three methods are allowed by GAAP. Just overseas, if you go and practice overseas, if you leave here when you're done, you will probably not run into LIFO if a company is using international accounting standards. And then if a company is using LIFO for the IRS, they've got to use LIFO for financial statements as well. But there is a possibility, and this is a little bit weird, but it can happen, that a company could use could report LIFO, on its financial statements, basically because I already said if you use LIFO for tax, you got to use it for your financial reporting. But they may still, for internal calculations, do some of those things. Here it says, right, they may still maintain some of their numbers on FIFO or average cost or something for internal reporting purposes, for any number of reasons that you don't really need to be concerned with at the moment. But what that does mean is that, let's say a company is using FIFO for just internal calculations, but they know that when they do their financial statements, it has to be on LIFO. Obviously, there must be some adjustment, right, that has to be made, some journal entry that has to be made so that the numbers are properly reflecting whether, it's on FIFO or LIFO. And what I mean by that is, excuse me, if you just go up here and you see, right, the ending inventory, when we did Perpetual LIFO, ending inventory was low at 27,500. Compared to Perpetual FIFO, the ending inventory there is 33,000. So if I was using Perpetual FIFO for my internal reporting, I would end on 33,000, but I would actually, for my financial statements, need to show this number, 27,500. So that would mean I need to make an adjustment, right? I have to say 33,000 minus 27,500, and my inventory has to go down, right, by 5,500, and my cost of goods sold has to go up. So I would literally say debit cost of goods sold and credit inventory, and each of that with 5,500. That would be the adjusting, or let me just do this, sorry. That would be the adjusting journal entry that I need to make if I'm going to move from FIFO to LIFO. Okay, so I repeat, sometimes companies use one method for internal reporting, but they have to use another method for external. This is more likely that they use FIFO internally, but because they use LIFO for taxes, they got to report on a LIFO basis for financial reporting because of the conformity rule. So they look at the difference between how much inventory is under FIFO and how much the inventory is under LIFO. In our example, it was 33,000 and 27,500 respectively. And then they make a journal entry to decrease the inventory to get it to the LIFO inventory amount, and increase the cost of goods sold to get it to the LIFO cost of goods sold amount. And when they're doing that, this is what the book is referring to as the LIFO reserve. It's the difference between the inventory method used for internal purposes and what the number would be if it was LIFO. And from year to year, you will change this balance depending on what your calculations come up with. So let's just look at an example. This is not a major topic in our work, but it's something that you should know, because sometimes companies do disclose in the footnotes to their financial statements that the LIFO reserve, is $10, and you shouldn't have to wonder, what is a LIFO reserve. So to illustrate, assume that Acme Boot Company uses the FIFO method for internal reporting purposes and LIFO for external. And again, the financial statements are external, management accounting and other things internal. At January the 1st, 2018, the LIFO reserve balance is 20,000. That means that the difference between FIFO and LIFO, right, is 20,000. This means that at the beginning of the year, the inventory balance under LIFO is 20,000 lower than it would be under FIFO, which makes sense because just by rules, ending inventory under LIFO is always lower than FIFO if prices are going up, and generally prices are going up. I mean, even now prices are really going up because we're having some inflation in the United States. You've probably seen it when you've gone to the supermarket. So the balance under LIFO is 20,000 lower than it would be under FIFO. At December 31, 2018, so at the end of the year, right? So you've got a 20,000 balance at the beginning of the year. At the end of the year, the balance in the LIFO reserve should be 50,000, right? So the difference between those two numbers is 30,000. So they're saying that the LIFO reserve needs to go up by 30,000. As a result, Acme Boot realizes a LIFO effect. This is saying that because of the LIFO method, inventory is lower by 30,000 under LIFO and makes the following entry. Cost of goods sold goes up by 30,000. Instead of crediting inventory directly, like I did that on my example, but instead of crediting inventory directly, you can credit an account called LIFO reserve. This balance in this account will be subtracted from the inventory balance to change the number from LIFO to, the balance in this account will be subtracted to change the number from the FIFO inventory balance to the LIFO inventory balance. Acme Boot deducts the balance in the LIFO reserve from inventory under FIFO to ensure that it states the inventory on a LIFO basis at year end. So companies should disclose either the LIFO reserve or the replacement cost of inventory, because inventory under LIFO is such old inventory, right? You either have to show what would it actually cost to replace this inventory, or you have to show the reserve amount so people can know, because there's a level of manipulation that's going on, right? Because we're making this assumption and maybe manipulation is a strong word, but we're making an assumption about how inventory is flowing that is not in fact the case. If we had to go and replace all this inventory that we're pricing out under LIFO today, we would be paying a much different price than what is being shown in the ending inventory. So they're asking that the users be given enough information to make their own conclusions about the value of the inventory at the end of the year. And of course, if by some bizarre situation, everything is opposite, like LIFO is actually ending up with higher inventory, which is very rare, that's meaning that prices are dropping. You argue this in the reverse. I'm not going to work it through because it basically doesn't happen. We generally live in a society where prices are going up, even if they're only going up incrementally. Okay, so little bit of a tricky notion here about the LIFO reserve, but what you need to remember is companies could have an internal, the internal books are under FIFO, but they have to report in their financial statements that it's LIFO. So they have to keep record of the dollar amount difference in the ending inventory between FIFO and LIFO. If I was working at a company and this was my first year, then this 5,500 would be that amount. And if I want to be really specific, I would call this the LIFO reserve, and the LIFO reserve would be at 5,500 at the end of the first year. And next year we do these calculations again and see what the difference is between the two inventory amounts for FIFO and LIFO and change the reserve based on that difference. Okay, so if you're reading about this in the textbook, don't get too worried. It's maybe, I don't know, it sounds more complicated than what it is. You're just trying to come up with a number that shows the difference between these two methods for your ending inventory amount, and then you're debiting cost of goods sold with that amount and crediting the reserve. Does anybody have a question or something that you want me to explain further about that? All right. So now, a few things here before we come to dollar value LIFO. The rest of the stuff is about LIFO and how you can run into some problems with LIFO. I would think that especially even now in COVID times where companies actually are at times struggling to get their hands on inventory because of all the supply side issues. Like if you just think of the issues with semiconductor chips and the car manufacturers and so on, you start to see how having these different layers of inventory, like if we just go back here, right? If you see here, right, going back to the beginning of this question, under LIFO, you're assuming the last thing in is the first thing out. So your ending inventory is going to be these oldest units. But just think for a minute, right? If you are a company that is, we're in COVID, we're struggling to get maybe products, we're struggling to get supplies, shelves are empty. If you come to the end of the year and you have to do your calculations for your cost flow assumptions, more often than not, you would expect that this layer of inventory, this old layer at a very low price, is never going to make its way into cost of goods sold because you're always buying new inventory all the time. So you expect that, the purchases at the bottom just keep happening so that in the end, your old layers from previous years and so on are never going to be what we call liquidated, meaning they will never be assumed to be sold. They kind of just stay in ending inventory kind of almost forever because you keep buying new inventory all the time. But say there is a supply side issue, which there has been for a while now during COVID, it might mean that you don't have the ability to buy more inventory. So when you come to the end of the year, you might find that you start liquidating or assuming as sold things that cost, a price that is so old. Like look at the difference between these two prices, 750 and 550. So what that could end up doing is making your cost of goods sold under your LIFO assumption much lower than what it should really be. Because remember, these units don't necessarily physically exist anymore. You're just assuming that they are still there because GAAP allows you to make that assumption. So you could have, and this is the notion of LIFO liquidations, you could have the situation where your revenue from selling the units doesn't really match with your expense, cost of goods sold, because you're assuming that these old layers of LIFO inventory are being sold because you're not able to buy new inventory at the rate that would prevent a liquidation from happening. So it causes what we would call like a paper profit, almost say showing a profit that is maybe much higher than it actually is because you have revenue at current prices, but your cost of goods sold is at old prices from years ago. And so, I mean, the company will have to disclose in the footnotes, right, that there's been a liquidation of LIFO layers. But the better option is to try and find ways to account for inventory so that liquidations are so rare or they may not even happen at all, because we don't want to end up in a situation where our revenue and expenses are so mismatched that we end up showing more profit than what has truly happened, in the books, which could end up in more taxes. It could end up, in higher bonuses when actually it's all just book entries, right? So there are ways to prevent this. And some of the ways that, you'll see are discussed are things like creating inventory pools. So let's just say now that the weather's getting colder, let's think about some snow sports, right? If anybody is involved in that, if not, just play along. If you're going onto the snow, you could be skiing, you could be snowboarding, you could be snow tubing, etc., etc. So what we could do if we were, let's say we're Burton, we're a snow, we're a company making all kinds of snow sports equipment, we could just have a separate LIFO calculation for our snowboards, a separate one for our skis, a separate one for snowshoes, let's say, or we could combine all of those, all of that inventory together into what we call one pool of similar inventory, so that, let's just say we're struggling with supply and we can't get a particular part to be able to manufacture more snowshoes. So we're getting kind of to the end of our inventory of snowshoes, but because we're in a pool with snowboards and skis, we're not going to end up liquidating a layer of our inventory, because where one thing might go down, one type of inventory might decrease in the pool, another inventory item could offset that decrease by increasing, and so on. Okay, so basically what that does, again, is it prevents this liquidation where you mismatch revenues and expenses. So you combine these things as a group, they're similar. If you sell out all your snowboards, it won't necessarily result in a liquidation. You could just have the pool substitute other items so that you never end up going into this kind of, oh, now we have to assume that these super old units are sold, and that's not even really what happened, and it's going to end up making our financials look really weird. So that's combining units together to make a pool, right? That's an option to try and prevent. All of this is about preventing this LIFO liquidation effect. Another option is what you saw in, what I was talking about before, is dollar value LIFO. So again, all of this is options instead of just using specific unit LIFO, right? The specific units. What we were doing over here is specific unit LIFO. You're saying these are the units of this item that we're selling, etc. Right? So the dollar value LIFO, as opposed to the pools where you're working with combining units of similar products into a pool, with dollar value, you're actually just going based on the dollar amount of inventory that exists, as opposed to trying to match that to specific units. So let's just read here for a minute. The dollar value LIFO method determines and measures any increases and decreases in a pool in terms of dollar value, not the physical quantity of goods in the inventory pool. Okay, so what that means is you're looking over here at dollar amounts, you're ignoring how many units that relates to, and just focusing on what's the dollar amount of inventory that is left over at the end of the year, and which year did that come from. Companies often use dollar value LIFO in practice. And why? Because you can include a broad range of goods in the dollar value LIFO pool. And so that again means that things offset each other. If one thing is going down, something else might be going up. And so you don't end up liquidating. I just want to make sure in your mind that the reason, because, I can talk on and on and on and on, blah, blah, blah. But the reason that we're going into this level of detail is companies' financial statements can really look almost like they are misstated if they start having liquidation of LIFO layers, because of the fact that those prices from the old layers those prices are almost ancient sometimes, so their cost of goods sold number just looks crazy. So this is all trying to prevent a LIFO liquidation. And then the second reason, or advantage rather, of dollar value is that it permits replacement of goods that are similar, use similar items. And so the erosion or the liquidation of the LIFO layers is not happening as frequently with just a regular LIFO pool. The items have to almost be identical to some extent. I mean, I said snow equipment, so I think you can make an argument for it. But with dollar value LIFO, you can basically go crazy and include almost whatever you want into the pool. So under the dollar value LIFO method, we determine whether a new LIFO layer was added by comparing the ending dollar amount with the beginning dollar amount of inventory. This is all very theoretical. We're going to do an example here in a minute so you can see what's going on. I'm just going through the theory to try and lay the foundation, but don't be surprised if it doesn't make a ton of sense. It will make a little bit more sense when we do the work together, and then it will make even more sense when you do the homework yourself and when I go over it. So you're basically saying what was what was the beginning inventory? Oh, it was $10. What's the ending inventory? It's $12. So $2 difference. So, you know, did we actually just buy a whole lot of inventory, and $2 of inventories is left over in addition to what was there before? Okay, that's fine. But have prices gone up over the course of the year? So is it truly $2 worth of inventory, or does it have something to do with inflation that's also causing the dollar amount at the end of the year to be different? So if the price level has changed, we need a way to determine whether an observed increase is a real increase. So is a dollar amount real, or do we need to take into account inflation? So we will use a price index. You may have run into this in your economics classes, where they ask what is the consumer price index. So basically, what is inflation? By how much have prices gone up? And I will show you how we use that price index to determine whether the increase in inventory is actually due to an increase in the number of units of inventory, or is it just due to price inflation. All right, because ending inventory should really only be considered to have increased if there were units that were added, as opposed to prices just going up. So if I have one phone and the phone costs, you know, $500 or whatever, and at the end of the year I still have one phone, but because there's some supply chain issue, now the phone will cost $600. I still only have one phone, right? It's just inflation that has caused the price to go up by so much. So we're just trying to make sure when we do this calculation, because dollar value LIFO is based on actual dollar amounts and not inventory units, that we don't overstate our inventory amount at the end of the year by taking inflation as an increase in the actual number of units. So that's the story, and I'll go into calculations that might help to illuminate this a little bit more. And I know that this is, you know, not necessarily an easy undertaking, dollar value LIFO. So if you feel like pulling your hair out at some point, that's okay, that's normal. But we will try to do some, you know, repetition so that people can feel a little bit more confident with this at the end. So if you want to follow along, it's going to be so I gave you a blank dollar value LIFO if you wanted to actually write stuff in, and then this solution is obviously the solution for the whole thing. Let me stop the share, and I'm gonna pull the sheet into the same Google Doc that I've been using all along, and then those who are I can see some people are logged into this document. Those who are following in the document, you'll be in dollar value LIFO, and the others can just observe. So I'm just going to stop the share for a second and just get my act together here. All right, so I just want to make sure that I didn't pause the recording by accident. So this is what the example looks like. It's kind of set up in a tabular format. You will see that, the book does something that is basically doing the same calculations, not necessarily in a tabular format, but it ends up in the same place. You can do this. You can do these calculations like what I'm doing, or you can do your own thing. I'm not, it's in Wiley, they do have a type of tabular format there, but I'm saying when you're kind of doing your rough calculations, figure out what works for you, as long as whatever you're punching into, onto the screen ends up being the same as what Wiley is expecting. How you do it on your rough work shouldn't really matter, right? So again, the purpose of dollar value LIFO is to try to avoid LIFO liquidation by combining various inventory items by dollar amount into ending inventory, right? And then using that ending inventory number to try and figure out whether new layers of inventory were created or not. Because we are using a price index, meaning we are saying that prices are increasing over time. I'll give you an example, or let me talk it through. We have the first year over here, which normally in this question it says in this year, which in this case is 2011, the company decides to adopt dollar value LIFO, right? That's referred to as the base year. For base, they're trying to say that the price index is 1 or 100, meaning that there's no inflation in that year. The price at that point is the base price. So if I said my phone costs $500, that's the base price, and 2021 is the base year. Okay, so in this example, the base year is 2011. The ending inventory at the current cost for the December 31, 2011 basically is $100,000, and we assume no inflation. That is just the base price of inventory. I just want to make sure we all understand what the purpose of the exercise is, to calculate the ending inventory, right? That's, remember, all this time we've been calculating ending inventory or cost of goods sold. Calculate ending inventory for this company for all of these years, 2011 through 2014, using dollar value LIFO. And so this method, once you crack it or understand it, it's the same thing over and over. You just have to be very detailed and in making sure how you're calculating the layers, that you're doing it accurately, and I'll show you how. So the way the process is going to work is every time we will look at what is the ending inventory at the current cost, then we will look at what the price index is. And if the price index is anything other than 100, which it will be, like look at the next year, it's 103. What this implies is that prices went up by 3% between 2012 and 2011, because remember, this is 100. If you look at this, it's 107. It's saying that prices went up by 7% in comparison to the base year, and so on and so forth, okay? So if your price is different from the base year, you basically restate your inventory at the base year cost, because you are trying to eliminate the impact of inflation. Remember, inflation is inflating the prices, but not increasing the actual dollar amount of inventory that we had in the first place. Just like I said with my phone, right? My phone costs $500 right now. If let's say by the end of the year, suddenly it's the price is $600, but it's just because, there's a shortage of chips. So phones are in short supply. It doesn't change the fact that I still just have this one phone that really should just be at a cost of 500 because I got it in the base year. Okay, so we don't want to overstate our inventory based on inflationary increases. We want to make sure that we figure out for each year that if there's an inventory layer in that year, that the price for that year applies to it, but any previous year needs to be at the prices of those previous years. Okay, and so I'll stop talking there, because if I keep talking, I could confuse the issue even more, because I'm sure people will say it's all spinning. And so then we figure out what the inventory layers are in each year and which year they relate to, and then ultimately what's the ending inventory. So for the first year, it's kind of easy in the sense that there's nothing to restate, because inventory is 100,000, inventory is $100,000, and there's, the index that we apply is 100 out of 100. So that's just nothing, right? It's 100,000. There's no restating. This is the first layer. So 100,000 is and by layer, I mean, it's the inventory, the ending inventory from that year. So it's the 2011 layer that has been created. Okay, and why I'm keeping track of that, remember with LIFO, the inventory relates to the earliest units. So we have to keep track of these early layers to make sure that we are carrying the layers with us as we go from year to year. Okay, so I need to differentiate because the prices are not the same every year that we're looking at. And so the ending inventory for that first year, it's pretty easy going. Right, I'm just putting it over here because later on we'll see that we need to add up stuff. Right now it's very obvious. Ending inventory is 100,000. So any questions there? Anybody? Something that seems not clear? Should be saying, what are we doing? Right, we're calculating ending inventory using dollar value LIFO for the base year, for which there are no adjustments because of inflation, because it's the first year. All right, so everything just stays the same. Now we come to 2012. Look, inventory of 120,000. So under normal circumstances, you would say, oh, it must be that we created an extra layer of inventory of $20,000 in 2012, because look, last year we had 100,000, now we have 120,000. So ending inventory has $20,000, right, of inventory from 2012. And then I'll say to you, whoa, stop. Right? Because there was 3% inflation. So built into this number is also an inflation, right, of this 100,000, because prices have gone up, right? So you have to be very careful to ask yourself, is this in fact a 20,000 layer that was just created in 2012? Or is it possible that 3,000 of the 20,000, I'm saying 100,000 times 3%, is actually because of the impact of inflation, right? Remember the phone? I still have just that one phone at the end of the year, but because of inflation, the price has gone up. Okay, so what we want to do is remove the impact of inflation on this earlier year, because this 3% should not apply to that. This should still be at 100. So what I'm going to do is I'm going to say 120,000, and I'm going to restate the inventory at the base year. So I'm going to say, what is the inventory at 2011 prices? Another way to do this is to say 120,000 divided by 1.03. Okay, you're trying to say, if all this inventory was at the base year, how much would it cost? So 116,505. So let me just put here, to restate at base year, you take the ending inventory. Oh, let me put it in numbers instead of writing it like that. You're saying 120,000 times 100 over 103, or 120,000 divided by 1.03, right? That's how you're restating it. That's how you come to the 116,505. Now, this is 120,000 at 2011 prices. So out of this, you know that one layer is 100,000, 100,000, which is the 2011 layer. We know that that stays at the same price because it's at the base year price, which then leaves us with $16,505, which kind of feels like a strange number. Like, what does that number mean? So this is 2012. This is the 2012 layer. But unfortunately, because of the restatement, it's now at 2011 prices. So there is a mismatch. And the reason it's at 2011 prices was because we are required by this approach to restate, right, every year at base year prices so that we can remove the impact of inflation. So this doesn't make sense because the 2012 layer should be at 2012 prices, but currently it's at 2011 prices. So what we need to do is we need to, and I know this is going to sound insane, but we're basically going to reinflate the 16,505 to 2012 prices. Okay, so the way we do it is we say 16,505 and we write it up. So we say times 103 over 100. We write it back up to 2012 prices. So to write up 16,505 to 2012 prices, so reinflated, you are going to say 16,505 times 103 over 100, okay, or times 1.03. Notice how that comes out to 17,000, right? You don't have to reinflate the old layer because it's at the correct prices, right? This is the 2011 layer, and let me actually be very explicit, at 2011 prices, so it matches. Let me wrap it for you. It matches, so we don't have to do anything there. Here's the mismatch, 2012 layer, 2011 prices, so we have to reinflate it. So that ends up with 17,000. So your total ending inventory at in 2012 is actually 117,000, right? These two numbers together. It's not 120,000. So let me write it over here. So total ending inventory for 2012 is 100,000 plus 17,000, so 117,000. So if you're still awake at this point and you're thinking about it, it should make sense to you because what's the difference, right? The difference here is, and this really only works after the first year. It doesn't work so well if there are multiple layers created, but it's very obvious to see this. 120,000 minus 117,000, right? The difference is 3,000. The inventory went down by 3,000. Why? Because this 3,000 is the 3% inflation on the base year inventory of 100,000 that we needed to remove because it isn't actual, sorry, my typing is horrible today, isn't actual inventory or actual extra inventory. It's just inflation, right? Which we don't want. We don't want to inflate the base, yeah, okay, because it doesn't make sense. So to inflate it, because this layer was created in 2011, you can't state it at 2012 prices. So that's why this ending inventory number has gone down, right? The total ending inventory is only 117,000, not 120,000, because the base year should stay at 100,000. It shouldn't go to 103,000 because there was 3% inflation, because then you're overstating your inventory just based on a change in prices that happened in 2012, but that inventory related to 2011. So you have to keep it at the original price, which is also what we were doing with specific unit LIFO, right? You keep it at the original price. You don't go, let me show you what I mean. You don't say, oh, because prices have increased to 750 by October, I should change this also to 750, right? That's not how this works. We have to keep our early layers at their original prices. So the 2011 layer will always stay at 100,000, and we have to remove the impact of inflation on it at all times. Questions, anybody? You've made it thus far. I commend you.
Professor,
Mhm.
can I ask you, so can you please explain how can I find that 70,000?
Oh yeah, sure. So the way you write the 17,000 up is you take the 16.5 of, remember we restated 120,000, right? And we said 120,000 at base year prices comes to 116,505. Of that, 100,000 relates to 2011, and the remainder, 16,505, is the 2012 layer. The way you get to 17,000 from that is you re-inflate or write up the 16,505 by saying 16,505, add on the inflation of 3%. And when you say 16,505, either times 103 over 100, or let me hide this thing. So this thing gets kind of annoying, but I need to see if people are raising their hands. Or you can say 16,505 times 1.03. It's all going to end up being the same. That's going to give you $17,000.
I understand. Thank you.
Okay. Other questions, people? Now is the time. Now is the hour. Okay. I will not assume that everybody knows what's going on, but I'll assume that people are not yet ready to formulate a question, right? To ask me a question. So think about it. Let me do another, try to finish this for you before we gotta hit the road here today. So 2013, 118,000, right, is our ending inventory. So again, you might say, oh, wow, okay, so we went from 120 to 118, so we must have, sold all our inventory plus 2,000, of what was relating to previous years. You've got to be very careful because there's a 7% inflation over here. So you can't just assume anything about, about what this number really means until you restate the number at the base year prices and then check the layers to see, which layers apply and so on. So I'm going to say the same process. Remember, I said this becomes repetitive. So over here, it's going to be 118,000. And you're going to put it back to the base year price. So times 100 over 107. That means you're taking any inflation out. Okay, you can also divide by 1.07. The math is the same. Okay, I'm just doing it the long way around so that you can see the base year is what I want and I want to get rid of the inflation. So that's going to give you an ending inventory at 110,280. So you've restated it at the base year cost, right? 110,280 is what you're left with. So now you can definitely see that last year you had more. So this must mean that there was no extra layer of inventory created in 2013 because you don't have more inventory than the 116,505. But let's go through the process. So of this 110,280, 100,000 is going to be the 2011 layer at 2011 prices. So that layer is perfectly, so that layer is perfectly fine. We don't have to do anything more to it. There's a price match and we know how much the layer is. Then we end up with 10,280 is what's remaining after we get rid of the 100,000. So you see from before, right? The 2012 layer at 16,505. Now there's only 10,280. It means that we must have sold some of the units that were left over in 2012 and that we did not create a layer in 2013. So this is the 2012 layer at 2011 prices. So once again, there's a mismatch. Okay, that's what's left over of the 2012 layer. And for 2013, no layer, right? No layer created because we have nothing, zero. We have nothing left to work with. We just remember with LIFO, the earliest units are always left behind. So you always have to look for 2011, then you look for 2012, and then you might see that a new layer was created, but in this case it wasn't. I'm going based on the LIFO rules that the ending inventory consists of the earliest years. So yeah, I've got 100,000, I'm done. The 10,280, I need to re-inflate, right? But at 2012 prices, not 2013 prices, because this layer was created in 2012. So I have to say 10,280 times 103 over 100. I'll put it over here for you. 10,280 times 103 over 100. So I'm using the inflation percentage from when the layer was created, not from the year that I'm in. They may sometimes be the same, but in this case, they're not, right? This is 2012. I use the 2012 inflation, not the 2013 inflation. So my total ending inventory is now these two numbers, right? 110,588. Questions there. And so this is zero, right? Let's just put a big zero here so everybody can see that we didn't create a layer there. All of this, yeah, go ahead, Marina. Oh, somebody, Emnero.
This is Eric.
Eric, sorry.
So you used the 103 for 2012. I mean 102 for 103 for 2013 instead of 107.
No, 103 just for the 2012 layer to be, yeah, not 107 I used over here because I have to get back to, right? I have to get back to 2011 prices, and this was at 2013 prices. But over here, Eric, the rule is that you use the inflation related to the year that you are working with. So because I'm working with the 2012 layer, I got to use the 2012 inflation.
Thank you.
Okay. What else? Okay, so let's see if we can just round this out. And then remember these answers are already up on Blackboard for the people who want to go and try their luck. And the answers are up as spreadsheets so you can see the calculations, you know, that I'm doing in Excel. I wrote a whole lot of stuff over here, so it's a little bit difficult for me to put everything, but maybe what I should do is this. I'll just put total ending inventory for 2013. I just want to make sure that everyone sees that is 100,000 plus 10,588. So it's 110,588. Okay, that's important because that's the actual answer that we're looking for. Wait, what just happened? Let's say it's more speed. Okay, I'm trying to be so fast because I don't want to run out of time, but it's ending up making it worse. It's 100,000 plus 10,588 equals 110,588. Okay, so the standard held. So that's for 2013. That's your total ending inventory, which was, remember, that was the question that they were asking. And then in these last 5 minutes that we have here, at 2014, we see that at 2014 prices, the ending inventory is 130,000 and the inflation was 110. So that means that there's a 10% inflation between 2014 and the base year 2011. So what we got to do to restate this at the base year is say 130,000 times 100, because we want base year prices, divided by 110. Okay, so we end up with 118,182. So now you look at that and you look at what you had in the previous year, and you see, oh, I must have created an extra layer of inventory because I'm much higher than before. So remember, it's LIFO. So the earliest units are what's left in inventory. So you always have 100,000, right? The 2011 layer is always still going to be there because we're trying to avoid liquidation. So it's a 2011 layer at 2011 prices. So there's no price mismatch. Let me just drop this whole thing. This keeps messing up. Okay, and then you say, what about 2012? Well, there was 10,280 left over in 2012, so that must still be there because we have 118,000 of inventory. So 10,280 is the 2012 layer, but it's at 2011 prices, so we still have that mismatch, which we will fix in the next step. What about 2013? It's 0 because we didn't create an extra layer. So it must mean that there's a layer in 2014, right? Because you're saying 118, 182, and we've only accounted for 110,280. So it must mean that in 2014, we created a layer that is equal to 118,182 minus the 100,000 from 2011, minus the 10,280 from 2012, minus the 0 from 2013. So the layer from 2014 is 7,902. But remember, the 7,902 is the 2014 layer at 2011 prices. So again, there is a mismatch. So now in the last step, we say 100,000 is 100,000. There's no price mismatch. Over here, we have to use the same logic again, that we need to put the 10,280 at 2012 prices, right? Because that's when the layer was created. So we multiply it by 103 over 100. I'm using 2012 prices. It's the same calculation as before, right? You can basically drag the number down. It's the same number. And then this is 0, nothing to report over there. And now the 2014 layer, you have to say the 7,902 that was created multiplied by, write it back up. Remember, you use the inflation from the year that you are working with. So it's multiplied by 110 over 100. And so there's a new amount, 8692. This was 7,902 times 110 over 100. So we're using the 2014 inflation amount. So your total ending inventory for 2014 is going to be 119,280 because you're adding together 100,000 plus 10,588 plus 8,692, and that's dollar value LIFO. Very mechanical, very much attention to detail. You got to watch out that you're using the correct inflation. You also always have to remember the rules of LIFO, that the ending inventory is always the earliest years. That's why I know when I come up with this number, that when I start splitting it out, I always have to be looking at the earliest years first before I can see whether there were layers created in the current year. Any last question there about 2014 or anything that I did up to here? I see something in the chat. No, Professor. Okay. All right. So there is an example too, which we obviously won't hit today. It's very similar. The answers on the Zoom notes and materials. I obviously you should do the homework examples. I think there's maybe $2 value LIFOs, but if you just wanted to try your hand at dollar value LIFO to see if you actually know what's going on, that second example might be a good place to try, because I've given you the solution already. I just want to mention before we part here that there is a question in the homework that asks which section of the accounting standards codification relates to specific topics for inventory. As a starter, I just want to make sure that everyone knows that inventory is accounting standards codification number 330. So at least that's the beginning point. If you don't know how to get to the codification, I had shared this before, but I'm sharing again. This is the codification link. You can copy and paste this into your URL. Right, let me just do that quickly. You copy and paste it. I mean, you can also find this in the textbook. I don't know if it will be as specific to answer the question that they're asking you, but you paste the link I gave into the URL, then you go to basic view, which is free access, and you can then browse by topic. You select the basic view. I've already got an account, but you would create an account, or I think you don't even have to. Oh gosh, never mind. This is my my VNC is going to cause me to have to select all kinds of chimneys. But you go to I don't know if they'll ask you if I'm not a robot, but you can click on access the basic view, and then you go in and you'll see the codification is there. The codification is where all the the rules and principles relating to accounting for staff are held. You go to number 330 and you'll be able to see all the inventory things. If you're stuck, I'm happy to help you. Homework is unlimited attempts. There are hints and solutions and stuff. There's no penalty for even asking for help from the system. Okay, so sorry for the 1 minute over. We're done. I do have office hours at 1. I'll stick around here if people need more guidance, but if not, I've got all of your attendance, so we're good.